That was the last one. Okay. I'm assuming estimate. That's what I'm assuming. And then I'm giving him the kind of I think given this, we ought to start. I think given their structure and the stupid things I've done. Okay. All right. I'm going to go ahead and start now. Okay. I want to talk a little bit about Mario because you have to listen to Mario extremely closely. First of all, how does he decide what to buy? Does he give a crap whether you're older and you're going to need hips or you're more drug-addled and you're going to need rehab? Does he really care much about that? Don't be ridiculous. When he did the valuations, how did he do the valuations? He took some appropriate measure of value. In the case of the oil and gas company, what was it ultimately that he valued? Their acreage. And how did he value the acreage? Anybody? Transactions that were taking place when people were buying and selling acreage. That is a private market value. When he did beer companies, how did he value? What did he value on the beer companies? Anybody? What he valued was their EBIT plus depreciation and amortization on the theory that what about maintenance CapEx? It's relatively low and it's pretty much a constant fraction of that. And he took a multiple of that, and where did the multiple come from? Sorry? What two transactions did he talk about? Bush and InBev. And what was the other one? FEMSA, and who bought FEMSA? Heineken. So what he's interested in is taking those measures of value and putting a multiple on them. Where does the multiple come from? It comes from a private market value. Comes from a history of transactions. That's why he sent the people to Pennsylvania to find out what this acreage was leasing for and what people were paying for. What's the problem with private market value that comes up immediately when you think about the beer companies? At what multiple was the Anheuser-Busch deal done? Anybody? At about 15 times prospective EBITDA. And is the American beer market growing very rapidly? No. So that was a 15 multiple for a slow-growing business. At what multiple was the FEMSA deal done? Anybody? About 11 to maybe as low as 10, maybe as high as 12, depending on what went along with the deal. Is that a problem for him if he bought this crap at 15 times EBITDA in a slow-growing market, and Mexico's a faster-growing market? Yes. It was a problem for him. So how does he deal with changes like that, which he has lived through? If you bought cable companies based on the roughly 3,000 to 4,000 per point of presence or customer people were paying, and 2 years later, after AT&T stopped driving the market up, you were getting $2,000. What does that do to your investment? It makes it look not too damn good. So what is it about private market value that Gabelli is immediately aware of? It is scary. Now, how, therefore, does he propose to deal with that scariness? Exactly. He wants to sell it as soon and as close to that price as he can. And that's where the catalyst comes in. Now, whenever Mario speaks, therefore, what is he always doing for those companies? He's trying to sell them. And he's trying to sell them at a growth multiple. So when he talks these growth stupidities, it is not because he believes them. It's because he's hoping someone in this class will go back to their firms or some investment banker and say, hey, let's buy that at 15 times EBITDA. So you've got to be very careful to listen what he is doing in trying to be a non-confrontational catalyst, because it's always better if you sell this on the dream than the fear, versus what he is really doing that produced those outsized returns. Now, I have one last thing to say to you. If you do private market values, are you just going to depend on catalysts? What have you been taught to do? Well, what would make a private market value multiple a reasonable multiple as opposed to, say, 15 times, which is unreasonable? So if you're paying 15 times EBITDA, you are probably paying 25 times distributable earnings after investment, after tax. Is that a good private market value multiple? Well, it's a 4% earnings return. That's what 1 over 25% is. It's a 4% NOPAT return. Now, you may get a little more because you'll lever up. But at that rate, since the after-tax cost of debt is at least 4%, the leverage doesn't buy you that much. What do you get on top of the 4%? You get the growth. Where's the growth going to come from? Either from reinvestment opportunities, and does Anheuser-Busch have a lot of those? They have a lot of good places to deploy capital at above average returns. No. So what are you left with? Organic growth. And even if it requires no investment, what do you think organic growth in the beer market is in the United States in nominal terms? 2 to 3%. So at that multiple, that is a 6 to 7% return. Is that a good, sensible multiple? I hope you don't think so. So what you are going to do, in addition to sort of observing these multiples, is ask whether they make sense in terms of the likely returns that these investments are going to produce if there is no change in those multiples. Having said that, what would you also be reasonably well advised to do? Get out there, like Mario, and try and get somebody to buy it at an appropriately higher multiple. But I hope it's clear from that example, this is a consistent strategy. And with every breath Mario takes, he is working that catalyst strategy. But I hope you, when he went to value these companies, got a good idea of how he's using the private market value and what the shortcomings are. Any questions about that before I introduce tonight's speaker, who has a different take on how to make money in this market and also a very long, successful career, who actually works for Mario now? Yes?
So I was talking to him after the class about his MSG investment, and he basically wrote a research report that basically said that it's got 100% upside at its current price, and part of it is that either Dolan's are going to buy it back or it could sell, and therefore the private market value, it was all driven by this private market value. When I was talking to him about the likelihood of that, he said, look, they gave this to their son for him to have something to play with. They're never going to take it private themselves, and they're also never going to sell it. So in that case, you have a private market value that's driven off of specifically multiples paid for sports businesses that are totally unreasonable.
And what is he hoping happens? Think about what he's actually hoping happens. Does he need the Dolans to actually do the transaction there? Suppose that another similar sports business sold for that or a higher multiple. What is that going to do to the value of MSG?
So my issue is, isn't it only temporary, right?
Yes! Does he want to hold these things forever?
No,
he wants to dump them. He wants events that'll give him a good return at those values. And what are the events that are likely to do that?
Another sports team.
Of course. So what's he going to spend a lot of his time doing? Talking about how there are these 1%, 100% upsides from sports teams. Does that answer your question?
Yeah, I just see it as a greater full game now.
Yes, that's what it is. And what's going to keep you from playing that greater? It's not an uninformed greater fool game because you've seen the fools out there. And you're hoping there's a catalyst that'll drive them. But what's going to keep you guys out of that greater fool game until you really see a catalyst? Basically, the earnings power, and for a growth stock, how do you have to translate the earnings power so you have a good feel for what you're buying? If MSG were to represent a 4% return at these multiples, when you factor in a reasonable estimate of growth, when the market is trading at an 8% return, is that a sensible multiple or not? So how are you going to judge if a multiple is sensible or not? Sorry?
Against the market.
What against the market? Okay, I don't want you to do a value. Because when you do a value, you're going to be multiplying by 1 over a growth rate minus the cost of capital. What do I want you to look at directly to see? Because then there will be numbers there that will justify this return. What do I want you to do directly? I want you to look at the implied returns. Because you can make good assumptions about those and have a good sense of what's going on. Is that clear? And don't go near Madison Square Garden. Okay, unless you have inside information, and then probably you don't want to wind up in jail, so don't do it tonight. All right, Beth, I've set the stage.
All right, now to...
Oh, just page down.
Perfect. Okay. All right. Let me tell you a little bit about my background and how I ended up working with Mario and how I got into this business. Let me start off by saying, and this isn't patronizing because I'm in the company of Bruce, but I was thinking as I got on an airplane to fly out here today, if I was 20 years younger I would give my left arm to be sitting where you are today. And I made a different career path, a different choice for a career path, and I didn't choose to go get my MBA. And I thought about it, and then I was fortunate enough to go work for somebody in the business who really trained me. But today, if you want to be in the investment management business, you really do need your MBA. And that's, it's, when I graduated from college, you just needed your BA, and some people went back and got their MBAs, but for the most part, people my age, and I'm mid-25. I'll tell you, I'm 46 years old. People, and so, when I was getting out of college, people didn't go and, if you got your MBAs, you were going on to different things. But in the investment management business, you just didn't need it. But so, I just wanted to say that. So let me, I think it's helpful, if I were sitting where you were, and when I attend speeches and listen to what people have to say about the business or whatever, I always am interested in their background and how they got to where they are and what led them to where they are today. So let me spend a little bit and provide you perspective. So I graduated from college and I went to go work for Goldman Sachs on Wall Street on the sell side, and I worked for an international oil analyst who was on the partner track at Goldman, and this is when Goldman was still private. So you can imagine what my lifestyle was like. He, very long hours, weekends, the whole bit, and he, made partner, which was a wonderful thing for him. And I realized at that point, after being at Goldman for 2 years, I didn't really want to be on the sell side because I saw. My choice at that point was go back and get my MBA or do something different, because at Goldman they cycled you out after 2 years. And so I realized, why should I spend all my time trying to convince other people to buy stocks? Why wouldn't I go work somewhere where I could just take these ideas I have and buy them? So that was the first decision I made. And then I through just fortunate circumstances, went to go work for a fellow named Bob Bruce, who used to be part of this program and has since retired from the business and is living up in New Hampshire on an old farm, and did very well. And Bob trained me in value investing. Bob was a partner at Cumberland Partners down on Wall Street, and he was hired by Jack Byrne, who had turned around Geico. I'm sure you've studied Jack Byrne in here. And Jack turned around Geico, and then he went to run Fireman's Fund. And Jack said to his friend Warren Buffett, "Listen, I need somebody to run my investment operations. Can you give me some names?" And Jack said, "Well, I have two guys, but the first guy won't take the job, so here's this guy." And he said, "No, I want that first guy." Well, that first guy was Bob Bruce. And so over the course of a several-year period, after I went up to work with Bruce and a young Bob.
By the way, it was Buffett who said that.
Yes.
Jack,
Buffett said.
Yeah, I got two guys.
Yes. Yeah.
Oh, did she say that?
Yes. Buffett said, "I have two guys," and Jack said, "I want the first guy," and he said, "You can't hire him." Well, that first guy was Bob Bruce. And so myself and 5 other young people went to go work for Bob. And actually, Tom Triforos, and I don't know if any of you have come across Tom. He was one of the guys that I worked with.
He's teaching in Canada.
Okay, all right. So we all worked for Bob, and through the course of this several-year period, Warren Buffett would come in, and we were in Greenwich, Connecticut, and we would drink cherry Cokes and eat hamburgers and talk about investments. And so that's really where I formed my philosophy and truly what it meant to be a value investor. And it was also at that point that I realized that I really wanted to have my own firm. And so I carried around this little black notebook, and over the next, I'd say 8-year period, about things that I wanted to do in this business, and if I had my own firm, what would it look like, and all this kind of stuff. And so I'm originally from Minnesota, and so I moved back to Minneapolis over 15 years ago, and started my own firm. I spent 2 years at First Bank, or U.S. Bank, and met 2 of my partners there, and we launched Woodland Partners. And so we launched Woodland Partners, and we opened our doors, and we said, which is an interesting business model. We're going to raise $500 million and close our doors to new business. and there were 3 of us. And so we raised $500 million and we closed our doors. And through just through partnerships and everything, you know, you don't always get along with your partners. And so one of the partners left, and so my other partner and I continued on, and then he wanted to retire. And I had met Mario when I was up in Greenwich, Connecticut, and he and I had kept a friendship going. And so I called him up and I said, I've got this, you know, $400 million asset management business. We had suffered some declines in the market, and I don't know what to do with it. And he said, geez, Beth, what do you want to do? And I said, I just want to manage money. I really am not interested in a whole lot of marketing. I really just want to manage money, and I don't want to manage people, which is another thing I've found in this business. People who are really good money managers are really lousy people managers. And so he said, well, why don't you come work for me? You can just run money, and we'll take care of everything else. So about 7 or 8 years ago, we sold to Mario, and so I'm now out in Minneapolis doing what I was doing. You know, I've always been doing, running small cap portfolios. So, and it's been the course now over, you know, really my time with Bob Bruce and carrying around that notebook that I formed this investment philosophy that I'm going to spend some time talking to you about today in terms of our philosophy, what we look for, how we go about finding ideas, the questions we ask, and then I'm going to do a little exercise with you guys to test your brain power. So, and it's not the same stock as last year, Bruce. So, okay. So, building from the ground up. We really build our portfolio. We run a portfolio of anywhere from 40 to 60 stocks. So for a small cap manager, that's pretty concentrated, because from what I understand, small cap managers generally run portfolios over, you know, maybe 100 to 150 stocks. And ours is more concentrated. And it's brick by brick. So we know what's in the Russell 2000 index, but we don't manage to it, and don't, you know, when we go in for business presentations or client meetings, they compare us to the Russell 2000, but we really don't manage to the index. So it's a brick by brick. So, and how do we get our ideas? New low lists, other investors who think like we do, Value Line, independent local research firms. We really don't use Wall Street research. There might be small little boutique firms that we know and we've had long-standing relationships with that say, geez, this is a stock we think that might fit with what you do. But for the most part, it's just that general curiosity about the world, looking for 4 different things, identifying ideas. Change that's going on inside a company that isn't appreciated by Wall Street. It might be a new CEO, it might be a company that's selling off underperforming assets and are going to focus on their core assets. It might be a new financial strategy. It might be a company that's deciding to get more financially disciplined. We're going to focus on return on capital over your cost of capital and not just spend money on a whim. 2, do they have a disciplined capital allocation process? You know, Warren Buffett has always said the allocation of capital is the most important decision any business manager can make. And tried and true, that's the absolutely true statement I've ever heard. So we really look for, do they have a disciplined process? Do they track where they've spent their money? Do they charge them for that money that they spend? So you have to earn over that cost of capital. High inside ownership. Do they have restricted stock grants that vest at increasing prices, or options that vest at increasing prices? Not these outright 3 million share grants at the market price. And then finally, and this is probably the most difficult to ascertain, we like to invest with strong management teams. Are they good leaders? Do they have a track record of success? How do they treat their employees? Do they listen to their employees? What's the dynamic between the CEO and the CFO in a meeting? And do they eat their own cooking? You know, they're more interested in creating value for the shareholders than they are about building their business and making it big. So those are the things we look for. So the second step is we've identified our idea, and then we say, okay, what is it, and what is it worth? It's really a very simple but very, very rigorously intensive 2-step process. What is it? We look at the income statement, balance sheet, cash flow, 5 years back, and try to project a couple of years forward, and we build a framework for the type of company we're dealing with. So Is it a beverage company that has extremely high returns, slow growth, and very high margins, and they have a tremendous excess cash flow? Or is it a steel company that's extremely cyclical, generates a lot of cash, but then has to spend that cash? So we build that framework to understand the type of company we're dealing with, and we really analyze all three financial statements. And then we say, what is it worth? And we arrive at that value down probably 6 or 7 different avenues. We use discounted cash flow, we use enterprise value to EBITDA, normalized operating profit, transactions of business that have occurred. Bruce talked about MSG and Mario wanting a transaction to occur in another sports team. That's a marker for what that business is worth. So we have a very extensive historical database of transactions that have occurred in our businesses that we can use to judge what a business is worth. So our goal in all this is to arrive at a value for a company that, and usually what happens is there's outliers. So you've got, these 6 different measures, and then you say, we're going to toss out the high and we're going to toss out a low, and then you're left with 4 or 5 different values, and then chances are those 4 or 5 different values are all within 10% of each other. And then we step back and we say, all right, we want to buy $1 worth of value for 65 cents. Not $1 worth of assets. That's the Benjamin Gray and David Dodd philosophy. We're more about, we want to buy the value and we're willing to pay 65 cents for that. And then our belief is that gives you enough of a margin of safety so that if you're wrong about some of the assumptions, you're going to have that downside protection. 1, because you've got transactions that most likely have occurred. And 2, you're paying enough of you're paying enough of a discount so that if you're wrong and the stock drops a little bit, you're not doing the, I'm going to pay 25 times earnings because it's growing at 25%. Well, and then you wake up the next day and the company says we're going to grow 10%. They're immediately going to discount that stock. That's not the kind of valuation analysis we use. So, the final step in all this is management. And this probably is, I shouldn't say probably, this is the most difficult piece to what we do. And I once heard Henry Kravis speak, and people have different opinions about whether or not he's successful or not, but I would say on average, he's been pretty successful. And he would say that, he said that management is the difference between the failure and success of a company. And I agree with that. Now, so judge management firsthand, ask distinctive questions. Do we want to be their partner? We spend a lot of time, and I live in Minnesota, so you can get on an airplane and fly to Chicago in 45 minutes you don't even have to leave. It's very funny. You don't have to leave O'Hare proper. Okay, you can drive around O'Hare and spend literally 2 or 3 weeks visiting companies just around the O'Hare airport. And the funny thing is, being a small cap manager, they don't, when you look at companies at $500 million market cap and below, chances are there aren't that many Wall Street analysts that have knocked on their door. Because, as I'm sure you all know, the Wall Street research is driven by investment banking. And so they can't justify following a $500 million market cap company because they can't trade enough stock in it to make it worth. So we find it very helpful, interesting, and insightful to spend time visiting companies because we find that we learn things that other people don't learn. And why is that? Because we ask distinctive questions. We are not concerned about how fast their earnings are going to grow, what they're going to earn next quarter. We're more concerned about what is your strategy to allocate capital? Why have your margins gone down in the last 2 years, and where can they go? How is your board compensated? How do you compensate your employees? How has your strategy changed over time? Has your strategy changed? And so, at the end of the day, what are we trying to determine? We're trying to determine if management's disciplined. Okay? Are they incented with shareholders' best interest? What's their plan to build value for us as shareholders? And do they think like owners of the business? That is a big, big point. And then ultimately what it leads to is, do we want to be partners with this management team? So, I once remember Seth Klarman talking about this, and I think it's a really critical question, especially in today's world. And as you go out into the investment manager world, if you choose to be in this business, what you want to ask yourself is, how do you stand apart from your peers? What is your edge in this business that allows you to add value, that allows you to identify stocks that are going to create value for your clients over your peers that's sitting next to you at a conference? It's not enough to say you have an analytical edge, because you can't analyze a balance sheet, income statement, or a cash flow statement better than anybody else. We all can do the ratio analysis. And, there's a lot of really bright people in this business. And full regulation FD has really, truly leveled the playing field. There's 3 areas that I want to talk about in terms of what's your edge. One is the information edge. The second is the emotional edge. And the third is your time horizon edge. So, information edge. So the question I always ask myself with companies is, where am I in the information chain? I'm not going to get better information, and I probably won't get better information than a Fidelity analyst about XYZ company that I'm trying to learn about, because Fidelity is going to get the first call on things. Okay, so hence why I really do traffic and small cap stocks. But it's really important to say, where am I in this information chain, and be creative about where you get your information from. I say this almost every year I come here, which is, it's amazing how much information I can get when I go to annual meetings. Because the whole board is there, and the senior management team is there. And, I've already met with the senior management team, but then you've got the board of directors there, and they, by law, technically have to be there. And it's amazing the things you can learn. So be creative. The second edge is, and this one has been particularly challenging over the last couple of years, and that is the emotional edge. Warren Buffett once said that investing isn't a business where people with 160 IQ beat a person with 130 IQ. The way that you really can be successful in this business is, one, to be bright and insightful and get better information. But 2, you have to have a really good temperament. So and you have to learn how to control that temperament. So if you come into your office and you thought XYZ company is worth 40 and the stock's trading at 25, and they come out with an announcement and the stock is down 25%, you have to sit on your hands and resist all temptation you have to sell the stock because it's going down. And it's very hard. It's very hard. So I think having the right temperament, and then the flip side of that is, you have to have the right temperament as the stock is going up and it's going through what you determine to be its value, to sell it. It's the greater fool theory. And as a value investor, your hope is you're buying it when nobody wants it and you're selling it as it's going up. And that's very hard to do. When you see a stock going up every day, you're thinking to myself, well, maybe my fair value has changed. Or maybe it's worth more than I think it's worth. And when you go back and you run all your valuation models and you can't justify it, you need to sell. And I think that's probably, if I think about my mistakes in this business and the ones that I unfortunately probably continue to make, that's one of them. I don't take money off the table as soon as I should. The final edge is the time horizon hedge. And unfortunately, this is very difficult in our business just because everybody's judged not only on a quarterly basis, but now the obsession is, how did your portfolio do today? And I think there are very few people in this business, and I'm not one of them. There are very few people in this business, Seth Klarman is one of them, that have the luxury to have clients that allow them to have a 5-year time horizon. And if you can have long standing clients that allow you to have that type of time horizon, you can have the luxury of making some really wonderful investments and sit with them, and it will pay off over time. The other thing I will say is that you can have a time horizon that's long, but your clients don't, and in the end, I mean, I think Jean-Marie has talked about that there's a very famous value investor who I can't remember the exact story that he told, but he, at the height of the hype in the market, when all the tech stocks were just, the NASDAQ was up, 40, 50%, and they were sitting with cash, and in the end, 2 or 3 years later, it looked like the right decision. A lot of value investors lost their client bases because they said, well, you're not doing as well as this person. And if you can have clients that understand what you're trying to do and achieve as a value investor, you really have a tremendous luxury and advantage in this business. So, okay, now comes the fun part, which is I want you guys to spend a minute and look at this business and what I want you to do is to look at this company, and I'm going to give you a couple numbers so you can write this down. Let's assume this company in 2000, let's pick a year, 2007, generated $118 million in revenue, had $1.33 per share in earnings, there were 14 million shares outstanding, and has $1 million in depreciation and amortization, no debt, and $60 million cash on the balance sheet. Okay? And as you're looking at this, let me tell you about this company. They make the Breathe Right strips, so I don't know how many of you snore or are high-performance athletes that want to breathe better, but they make those strips that you put across your nose. And they also make Fiber Choice. So if your colon has some problems, eat a couple of those tablets and you'll be just fine. So this is what I want you to do. I want you to look at this business and say to yourself, this is what, and this company was bought in 2007, I think. 2007 or 2008. I want you to look at this business and think and guess what you think it was sold for. It's a consumer products company with pretty high margins, and what I want you, let's just give me a multiple of revenue, a multiple of EBITDA, and a multiple of earnings that you think it was sold for. And I gave you all the numbers.
Yeah, can I just ask a question? How do they distribute the product in the period where?
They distribute it through mass merchandisers.
Okay.
CVS, Duane Reade.
Now, one other stuff. What we would pay for it, or what we need somebody else?
What do you think somebody? What do you think somebody would pay for it? Check the time.
Yeah.
Okay.
classes.
Are they really?
So,
All right, anybody who has a computer can't answer. Is the multiples of the deal on there?
I'm looking at
Oh, okay.
oh, it's somebody in this room.
a different model.
Yeah. Yeah. Okay. I didn't realize.
Yeah, it's,
Say that.
it's
So,
still-
yeah.
it's not everybody's got it. Some people actually
I believe everyone paying attention.
All right.
Okay, now we have to do the honesty. I'm going to be anybody who has a computer. I didn't quite realize that you guys could get access to the internet.
Yeah, well, welcome to the 21st century.
How many people found the deal on the internet? Okay, you guys can't answer the question then.
We guess much lower than what we found.
Yeah. Okay, so you guys can't answer. Okay. All right, now there's a couple reasons I did this exercise. One is this is how I learned the business. Every Tuesday night, Bob would sit us down in the conference room, and we would go through value line sheets. And so, the business has changed a lot, but you really can learn a lot by studying value line, even though this is outdated. You can really understand a business, and you could spend a half an hour with the management team asking questions just by looking at this sheet. So I learned the business on value line, and I just find it extremely helpful. So, okay. So before I tell you the deal price, I wanted to, your question is, what is a small cap value manager doing looking at a company like this? Well, let me tell you when we looked at it and why we got interested. If you go back to 2000, you'll see that the stock hit a low of $3, $2.97 to be exact. The year before that, Dan Cohen, who started this company, and Jerry Rice put it on the map. I don't know if you remember that. You guys are probably too young. But Jerry Rice, the wide receiver who's now retired, put Breathe Right on the map because I guess the Super Bowl, he wore this Breathe Right strip over his nose, and things exploded. So, but Dan Cohen was running this company, and what happened was, which is often what happens with these small entrepreneurial managed companies, the company got too big for him, and he couldn't get out of his own way. And so the board of directors had the wisdom to go out and hire a new CEO. And around 1998, they hired a new president, but she really didn't take over. I think she took over in like 2000. And the reason we got interested was the stock was at $7, and there was $3 in cash on the balance sheet. And they hired this woman named Marty Morfitt, who's now running, by the way, the brand Airborne. You know that brand? Yeah, she's now turning around Airborne for a private equity firm. But they hired her from Pillsbury, where she ran a $1.3 billion business for Pillsbury and took the margins from, I think, 5% to 16% and really grew the business and did an unbelievable job. And Pillsbury got bought, and so she was looking for something to do, and, she went to this $70 million company. And there was one analyst on Wall Street that followed. It wasn't even Wall Street. There was one local analyst out in Minneapolis that followed it, and nobody was paying attention. And I read that they had, I was always interested in the product, and Dan Cohen never was that impressive of a leader. And so they hired Marty, and I went out and spent some time with her. And she said to me in 2001, here's what we want to do with the business, Beth. The margins are, I think at that point they were around 7 or 8%. We think we can take them to at least 20%. This type of business should be 20 to 25% operating margins. They didn't manufacture any of the products, so they had extremely high gross margins. There's some things that we can do to get the margins up really quickly. So I ran the math, and I think at that point they were going to earn something like 50 cents. I ran the math, and I thought, okay, it could be a $100 million brand, 20% operating margins. It's $20 million in operating profit, tax affected. They could do $1 in earnings. And the stock is $7 less the cash of $3, $4. So you have a $4 stock that they could earn easily $1 2 years out. So you scratch your head and you say, what am I missing in the equation? Nothing. People didn't care. It was a teeny little small cap company in Minnesota, and the market hadn't woken up to the fact that they got a new CEO. So we invested in the company at $8. The stock ran up to 27, and by all measures, we couldn't come up with any reason to hold on to it, so we sold. Then they had a bad cold and flu season, because cold and flu drove a lot of their business. And the stock dropped down to like 17 or 18, and we called them up, and now at this point there was $4 in cash on the balance sheet, and operating margins were going to go to 26%, and she had hired all these Pillsbury people. So she had brought in this whole new management team, which was was professional managed company now, and they had a strategic plan. And she said, we think we can take this company organically, plus, and then now they also have Fiber Choice, and I'm really serious about Fiber Choice. I have 3 children, and they have issues with their cold, and so we give them Fiber Choice tablets in the morning. The product works. So, anyways, they had this other product that was starting to grow rapidly. And she said, we think this could be a $300 million company easily, and we're going to do some small niche acquisitions. I think we've demonstrated that we really know what we're doing here. So, and they had the strategic plan. Well, so we invested at $18 again, and You guys are going to be astounded at the price. I'm not going to tell you the price. We're going to play the guessing game. But in October of 2006, CNS was acquired. Now, does anybody want to take a guess? I'm going to start with Bruce. Bruce, what do you think they got sold for?
$45 a
Okay. It's a little aggressive. A little aggressive.
I'll tell you why I think that, because I think that, especially once you say she is a big company manager,
Yeah.
so she knows how to take a product like this and pitch it to a big company and just say, oh, we're going to distribute this all over the world, and it's not going to be a $300 million product, it's going to be a $800 million
Yeah.
product.
That's exactly right. But 45 is a little high. A little high. Does anybody else want to take a guess? Too high.
38.50.
Very close. Okay? GlaxoSmithKline bought them for $37.50. Okay? Now, this is, Bruce was talking about at the start of class the greater fool theory. Okay? The greater fool in this was Glaxo. They paid, and this nice young guy right here you looked up multiples. So you can deals in the industry occur around 2.5 times revenue, 12 times EBITDA. Okay? Glaxo paid 4 times revenues. Okay? 16 times EBITDA and 28 times earnings.
You got it right also. I actually got it right beforehand. I said,
Oh, did you?
38.
well, the number
Okay.
was 2.5 at
Yeah.
the end of 09, and I assumed back in 06 that there was, the market was running rampant.
Yeah.
So I added a turn there. And then I looked at the growth of the company and the margins, and I
Yep.
assumed that there was probably like a premium paid for that, so I actually came out to 4 times revenue. So I ended up coming to an enterprise value of $540 million, and then a $38 price.
Yeah. He should be a banker, don't you think?
See, I think a banker could have done
But then I thought maybe $45 a share sounds like a better number. So
Yeah. Oh. So, you don't give A's. What do you give in business school? You don't get A's.
Here they get H's.
Okay. Is that the highest?
Yeah.
You just earned an H, an HP.
Give me your name after.
So anyways, I thought it would be helpful to walk through this exercise. One, in terms of our investment process and what we looked for, and actually I'm in a real life example. And 2, I thought it'd be interesting for you guys to get engaged, and I'm impressed at how close some of you were with the price. I mean, that's interesting, because that was at the froth of the market, and I don't think we'll see prices like this for a long time. I mean, I was astounded. I thought there was a chance that maybe when we did our evaluation work and we invested, I thought maybe $30. Some fool would come in and pay $30, but Marty shared with me after the fact that there was a bidding war and it got heated, and she said, you put your company up for sale. They did a strategic plan and they realized we can't get the business to where we wanted to be alone. It would be much more effective for us to be part of a bigger company that has bigger distribution and can really do it worldwide. And so they undertook the strategic process, and it was this frenzied process, and they got $37.50. So, yeah.
How much cost did the pharmaceutical company think they could take out? And was that factor into your analysis if they acquired this company?
When I came up with 30.
Yeah. Sure.
Well, there wasn't a lot of cost, because you think about they don't do any of the manufacturing, so there were really high gross margins. And I'd spent a lot of time in their facilities in Eden Prairie. They were in leased space in a building owned by somebody else, so you can take out some people costs. But obviously, they thought they could really grow the brand, like Bruce said, and get the distribution. I'll be very interested. I mean, Glaxo's so big that you have no idea if this worked out for them. But, yeah, so.
Okay, we now have a new innovation. I have them write questions ahead of time. So they
Okay. All right, so I'm done with the formal part.
Yes.
Okay.
Okay. Bilal Agarwal Sometimes they do good questions and they don't show up. Yes. Go ahead.
So I think a lot of my questions are already answered, but I was just wondering what are the risks associated with being a small cap investor, and is there some sort of discipline that you follow, which is different for small cap because less liquid in the long run?
Yep. The risks. Well, there's liquidity risk. There's event risk. There's a lot of risks, and when you run a more concentrated portfolio, those risks are enhanced. But I would say liquidity risk is one of them. But it also can work for you, because if you really believe in what you own and it goes down, you just buy more. But liquidity is one. The other risk is, with the nature of the way that we make our investments, there's the people risk. There's always business risk, okay? But you hope that you've done your analysis well enough and you've invested with good enough businesses so that, if they encounter some business issues, they resolve themselves over the course of 1 or 2 quarters. People risk. You invest in the business, but you're investing in the people, and you hope that you bet on the right horses. And sometimes you don't. And that's painful. But, you learn from that. You learn from that. Those signals of, wait, he says that he's focused on cost of capital, but they have this enormously gigantic headquarters that they just built, and there's, and I'm serious about, there's the jets and all those things that is still there. There's a disconnect, and you have to learn to ask the right questions to try to mitigate that people risk. So.
David Atterbury? David, go ahead.
I looked at that. I saw you own Constellation Brands, or maybe you have
Yep.
Constellation Brands.
Yep.
And I was reading about a change in the distribution network that they're currently trying to execute.
Yep.
And maybe you could talk about it if you think that's going to be successful, and if that factors into why you own the company.
We own the company for several reasons. I'll answer your question first about the distribution, and then I'll talk about why they own it. They used to use many different distributors across the United States to distribute their products. And their philosophy is if we concentrate the brands with fewer distributors, we'll be more important to those distributors, and they'll pay more attention, and we'll have more power with them. And there's been some concern in terms of the inventory, and is there too much inventory in the system from the old distributors, and trying to kind of even that out, okay? And I think it's the right strategy, and our beverage analyst thinks it's the right strategy, but time will tell. We own Constellation Brands for several reasons. One is...
tell people what Constellation Brands are.
They are a wine and spirits company. And then they've got this Crown Imports joint venture with Modelo. So, I don't mean this as an insult, but you're their perfect target market because they're kind of mid-priced brands. I'm just all assuming that you don't have jobs and you're all struggling, and you walk into a wine store and you're not going to spend $25 or $30 on a bottle of wine. You're going to spend $10. Okay, and they really are strong in those in kind of the low to mid price tier brands. Okay, so they've got this wine business and a spirits business, Svedka Vodka, and then they've got this joint venture, this beer joint venture with Modelo, St. Pauli Girl and Corona. And our feeling is, and I don't have my numbers with me, but you're basically at stocks 15 or 16, you're paying for the wine business today. So you're spending $16 and getting the wine business, and you're getting the beer business for free because the market's giving you no credit for the beer business. So we think that we bought the stock around 12. It's 15 or 16. I think it's worth $22, $23. Now, the really important thing is Constellation Brands has been a really crummy run company. They're up in Canandaigua, New York. I went to school not too far from there, and the Sands family controls the company through A and B stock. And they have not been financially focused. They've been focused on buying brands. They haven't paid attention to margins. So all of a sudden they woke up and realized, wait a second, our margins are subpar. We get no respect on Wall Street. and we can do something about that. So they're focused on getting their margins up, they're focused on paying down debt, and they're focused on getting increased value for their stock. So those are the main reasons we own. And they just announced they're going to buy back $300 million of stock just this past week. So.
Manisha Kathuria. All right, I'll stand in for it. According to you, what are the key differences in evaluating investments in small caps versus large caps?
The key differences?
Yeah.
The key difference is information. How am I going to know? How do I know more about somebody than about IBM or Google or Microsoft or Apple? Unless I've got a close personal relationship with Steve Jobs, and then it's bordering on inside information. Versus knowing more about CNS because I can drive out to their headquarters and one person from a local firm follows it. So it's about information and access to the information and misunderstood opportunities and neglect. That's the big difference. And there's a lot more opportunities to add value as a small cap manager than I think as a large cap manager.
Okay, Karuna Chabra. Wants to know why you're buying Jewel Wind when its cash from operations has been negative over the last 2 years and the firm has been having to raise outside capital.
Yep. It's a good question. Jewel Wind is a community, they're the only company in the United States that is based on community-based wind development. So they go in and they get the support of the communities to build these wind farms. And they are on the cusp of earning a lot of money. And they just recently, about a year ago, they hired this fellow from Chicago that ran some utility operations and was very involved in their alternative energy development. And he is focused on growing Jewel Wind and getting it profitable. Dan Jewell is not very well known, excuse me, outside of the wind industry, but he is an icon in the industry. So if you Google him, he will come up, and he is very well known in terms of wind-based development. And they're going to get revenue streams from several different ways in terms of the building of these wind farms. They're going to design them. They're going to help. They're going to manage the project. They're going to take a cut from the actual power that's produced. So they hook up the community with the utility, with the county, with the community, and they do the whole thing. And I think at some point over time, Jewel Wind will be bought. I think it's that Dan Jewell is an icon in the industry, and they have a business plan that is none like other. And they're on the cusp of turning profitability.
Okay, Sunil Sarathi.
I think you spoke a little bit about management, and you mentioned in your, I think, perspective that you sell out of a position when you see management doing things that kind of diminish your confidence in their ability to work on their strategy. So I'm just looking for some signs, some key things that you look for.
Sure. If management says, like for example, if Constellation Brands, which has espoused this philosophy and stated this philosophy that they're going to focus on operating margins and they're going to take their excess cash flow and pay down debt and buy back stock, all of a sudden they start making acquisitions and there's not a logical explanation. It's like, well, wait a second, you said you were going to do this, this, and this, and now you're going out and buying brands. That's a big thing. So it's when they deviate from the strategy that they've laid out. Okay, that's the biggest reason we sell a stock in terms of management. Or
can you give a historical example of that, where you really got blindsided historically? Position you own and you just don't.
Yes. Harnish Baker, which went into bankruptcy. and now has come out as Joy Global, and it's been this huge home run. But we were shareholders in Harshfager, and it's based in Milwaukee. So they talked about we're a return on invested capital EVA company, and we're very focused on creating value for our shareholders. So bless you, my business partner and I got on a plane and flew to Milwaukee and drove up, and this was the first red flag, and I should have paid attention to it. They had the biggest, most elaborate headquarters I've seen for a company market cap their size, right on this beautiful lake, with these enormous conference rooms with glass walls. I mean, it was fancy. And that should have been a red flag. Like, wait a second, how does this factor into cost of capital, and where did the expense for this go? You know, so that was the first thing. So, but they talked about, you know, we're going to improve our EVA, and they're a mining company, so they make equipment for mining, right? And we're very focused on improving the returns, and you know, the mining business is going to grow, and our margins are going to be X, and you know, this is what we're going to do. Well, what happened was one, the business never materialized. Okay, but that wasn't their fault. Two, they sold a couple non-core assets, and when you calculate EVA, you are not supposed to put that into your economic profit, because that's kind of a non-core item, right? I mean, it's not part of the ongoing business, and it's an extraordinary. Well, they put it in the calculation for EVA, which is really unethical. So as a result, they ended up paying themselves big bonuses. And you know, we put the pieces together, and I just, you know, I couldn't make sense of it. And so we questioned him, and we said, you know what, this is very inconsistent with what you're telling us. The mining market hasn't materialized. And, you know, fortunately, we got out, and then the company went into bankruptcy. But that's an example where, well, we lost money on it, too. You know, so you have to, you know, watch the signs and make, you know, and keep detailed notes. I mean, you know, one of the things I love to do after I met with after I've had a couple meetings with the management team is I bring my notes from the past meeting back, and all of a sudden their eyes roll because they're like, "Oh God, she's going to quote what we said 3 months ago." But you know what? That's how I keep them consistent, and that's how I know they're doing what they said they were going to do. Because I can't always remember what they said they were going to do, but if I've got my notes, I can hold them accountable and hold myself accountable.
David Kirschenbaum?
Yeah. So I think you owned or currently own the company Tier Technologies.
Yep.
And I don't know much about the company, but I saw that at least for the last few years, it's kind of had negative earnings.
Yes.
A bit of a mixed free cash flow profile.
Yes.
I was wondering if one, you could sort of speak to that specifically a little, your emphasis, and then more broadly, with a company like that, how do you sort of get conviction around, you know, the economic worth of that company?
Tier is a turnaround story, and if you pay your taxes online, the IRS allows you to pay it from, really, there's only 2 authorized firms that you can pay your taxes through. One is Link2Gov, which is owned by Metavante, which is now owned by, just got bought, I can't remember the name of the firm. Somebody bought Metavante. And then there's officialpayments.com. And officialpayments.com is Tier Technologies' website. Okay? And so our investment in Tier is, one, they've thrown out the management team and somebody from the board who's okay but not great. But some activists have gotten in there and have changed some things around. But they've reduced their cost structure. They have close to $4 in cash on the balance sheet, and the stock is $7.50. So you're in essence paying $3.50 for this tax business, which, you know, in a time like not today isn't doing that well because they get paid on per transaction. So they get paid as a percentage of the transaction. And you know, everybody's income has gone down, so taxes have gone down, which means the amount that they take has gone down. And the real earning power of that wonderful tax business has been masked by all these other crappy businesses. So what you've seen over the last couple of years are these really lousy businesses that have lost money because of the prior management team. And now what you're going to see going forward is a business that's going to generate, at some point, probably 10 to 15% EBITDA margins. And as we looked at comparable transactions, and Link2Gov got bought by Metavante, If you run the comparable transactions, you can come up. Link to Gulf got bought at like 3 times revenues. You can do the comparable transactions and get like a $12 stock price per share. So I think, and some activists have gotten involved, and they're really trying to stir the pot. And he's upgraded the board. And so our case is, they're going to be successful, which I think they're starting to be, because you're going to start to see positive EBITDA and then positive earnings per share, because these other businesses are out of the way. And you've got the cash building, and they're buying back stock, and they've got this platform which is extremely valuable, and somebody wanted linked above, and the other one is official payments. So we think at some point they'll be bought.
So basically what you do is you kill the bad divisions.
Yeah.
And you see what's left.
Right.
And you value that.
And so we've valued officialpayments.com, which we think is probably worth $8 a share, and then you add the cash. And you've got an $11, $12 stock. It's at $7.50 today.
Joyce Clark.
I was wondering whether you can talk about your investment in Scholastic, particularly because whether you're concerned about the other threats coming from the media industry to the publishing.
Sure. I've known Scholastic a long time and have a long history with Dick Robinson. That's one of the great fun benefits, one of the few benefits of being in this business and having gray hair, even though you can't see it. Dick Robinson, up until about 2 years ago, if you talk to anybody in the publishing industry, was kind of a laughing stock. Because the feeling was anybody who can publish Harry Potter and not make money shouldn't be in the publishing business. I mean, that's what people in the publishing, I checked with people in the publishing industry, and they had 7 editions of Harry Potter. And if you look at their value line chart, they'd have these huge years, and then the next year would be a disaster. And Dick and his family own, I think, 40% of this company. And he got religion about 2 years ago, and he brought in a new CFO. And he said to the new CFO, look, our margins are 5%. Our peer group is at least 15, if not higher. We seem to have all these businesses that can't earn money. We need to clean this organization up and get the margins up and create value. And Dick is 67 or 68, and I think he either wants to leave this wonderful legacy behind with a much higher stock price or sell Scholastic. I'm not sure what. I still can't figure it out. I haven't decided. But anyway, so we invested at $10. And our investment at $10 about 2 years ago was based on the belief of, and I can't remember the numbers offhand, but that if Dick can get the margins to 10%, 9 to 10%, which is not unreasonable given their business. I mean, if you look at book clubs and book fairs, and they've got this unbelievable Scholastic educational technology business. It's called Read 180 and System 44. They've got these wonderful brands. So we figured if you could take the margins to 10%, I think the earnings would be like, I'm trying to remember, like $1.70, and the stock was 10. I thought, okay, that's a pretty easy investment decision to make. We're just trading, 6 or 7 times earnings. The stock now has run up to 26 or 27. And we believe that the margins will go north of 10%. They say that they're investing the money in technology to deal with the e-reader, and they've got all this stuff going on that they're not willing to talk about right now for competitive reasons because of what's going on in the other educational stocks and the other educational publishers. Yes, I'm concerned about it, but I think they have enough of an infrastructure and they're responsive enough that I think they'll get products to the market that be able to respond in a way that should thwart the competitive threat. It won't overcome it, but I think it'll thwart it, and I think they have such strong brand content that if Dick decided tomorrow to sell the company, there would be a bidding frenzy for Scholastic, and I do believe that company could get sold for about $40 a share if he decides to sell it. So.
All right, Kevin Sales.
Yep. Could you talk about deluxe checks?
Yep.
How you found it, why you like it?
Deluxe is based in Minnesota, and It was a sleepy company that had a very entrenched management, and they brought in, 3 years ago, a fellow by the name of Lee Schramm. And Lee Schramm came from NCR, where he was one of Mark Hurd's 2 or 3 top lieutenants in terms of turning NCR around. And Mark Hurd turned NCR around, and then he went off, and now he's a Hewlett-Packard. And so they went outside, and then I think, I know what happened. Mark left NCR, and Lee didn't get the top job. And so he said, all right, I'm going to go somewhere else. So he was, somehow the headhunting world found him, and he took the job at Deluxe. Our investment in Deluxe is the following. You've got a check business that generates unbelievable cash flows. It's declining 3 to 4% a year, okay? But has very high margins and generates unbelievable cash flows. And so what he's doing is he's taking the cash flows from the declining check business and growing his small business services business. So, if you're a small business and you want to go somewhere to do one-stop shopping, you want somebody to help you do a website and provide your checks and your forms and, do office supplies and all that kind of stuff, all you need to do is call up your Deluxe representatives and they can do the full service. And believe it or not, that business is growing double digit. I was surprised. So Lee's taking the cash from that. They're also buying back stock. They're bringing the leverage down in the company. The stock trades around 18 or 19. When we invested it was around 12 or 13. I think it trades at something like 6 or 7 times EBITDA and 9 times earnings. I think the valuation is very low, and I don't think Wall Street is paying attention to the transformation that's occurring at Deluxe. They still haven't given him full credit for what he's doing with this company, because they say Deluxe, it's a crappy business, checks, everybody pays their bills online. No, and it's not. It's not the truth. And nobody really follows it on Wall Street. There's like 2 analysts, I think. So.
Philip Bergen. Okay, I'll do this one. Ms. Lilly. He's got Mrs. here. What would you say are the 3 traits that make a successful value investment? 3 most important traits.
Consistent discipline. One of the things I try to do is read the quarterly letters from all the very well-known value investors. And if you see what they say, it's always consistent. They always fall back to the same philosophy they followed. And I try to do the same thing. Your process needs to be the same. How you approach things need to be the same. How you value stocks needs to be the same. You've got to get that consistent discipline. 2, I think you have to have a good temperament, both in terms of being able to, I love this phrase, be greedy when others are fearful and fearful when others are greedy. So when nobody wants to buy, when nobody wanted to own Scholastic at $10, you have the courage to step in. It's hard to do because you think the markets, when that screen is, and you guys all know this, but when that screen's staring at you and Scholastic's trading at $10, but you think it's worth $35, you're saying to yourself, somebody knows something I don't know. Instead of saying, what do I know? I visited with the management team. What do I know that somebody doesn't know? And how firm am I in my convictions? So, consistent philosophy, temperament, and a love for being a value investor. I love what I do. I love being a value investor. I love going places. My favorite thing to do is to walk into a meeting and not have it be very crowded. Because then I think to myself, oh, good. I'm here before everybody else. I can get information. People aren't paying attention to it. I can get that edge and try to help make money for my clients before, it gets picked up by other analysts or when other people appreciate it. So.
Okay, Alexander, this is the last one. Alexander, I'm sorry, I butchered his name. Pandavis Hexner? He's not here, so he can't defend himself. This one has you as Nisler. The Dow at 11,000 plus and an increased positive segment in the market. How do you do value investing in a potentially overvalued market? You look for stocks in other countries, other asset classes, etc. What do you do in a market like this?
Not much different than what I was doing 6 months ago, except probably trying to be a little more disciplined about selling. When you see a Gaylord Entertainment go from $8 to $30 in a very short period of time, or you see a Scholastic go from 10 to 27.
So are you selling Scholastic?
No. But yes, I was selling. I sold some Gaylord. You go back and you just are disciplined about, what did I pay for this? What do we think it's worth? And if I can't justify that it's going to go up, 15 to 20% in the next year, or it's still not at a significant discount to what I think it's worth, and nothing has changed, then we sell. So I would say I'm doing more selling, but I'm still finding stuff to buy. So.
Okay, thank you very much.
Can I ask one last question?
Yes.
I want to know how many people want to go into investment banking, investment management, and consulting. So let me start with investment management. All right. That's a change from years past.
Not really.
No? Oh, wait. This is what I want to
All
ask.
the people who have not raised, years past, that not willing to raise their hand has always been the biggest regard.
How many want to go work at a hedge fund? How many have jobs?
Ask how many want to be investment bankers. I think they're all stuff. And how many want to be consultants? They're all on. I hope they're all on.
I just want to say one last thing. I find it interesting. There's a lot of people that have jobs.
Yeah.
It was terrible 2 years ago.
Well, it's still wasn't.
Terrible last year.
2 years ago, it was only 2.
Thank you. Well, you know what?
Well, it's not just an
So, you know, when they do the research notes, that was terrific.
Oh, thank you. Oh, you're welcome.
It was really wonderful.
Oh, thanks.
The thing is, you didn't give the punchline away, which I'll get with you and describe.
Oh, right, yes, 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 yes.
All of them.
Well, hopefully I'll go see if I can just wait to basically the only I think the only thing is
Check in.
Deixa a mala que eu tinha em qualquer e vambora. Essa é a ideia. Agora, se tiver puta, a gente vai fazer pouso, eu não vou ligar. Se você puta bala, tá minha boca, não vou fazer check-in, vou chegar só se chegar. O único problema que tem é o seguinte: você vai muito boa, bateu uma agulha só. Só vai pegar outra coisa que eu fazer sexta-feira, pelo menos assim, 4 lugares ali uma hora. Eu não vou mexer toda a vida. Opa! O problema é o seguinte, tem esse cara camisa verde, esse cara tá verde, camisa verde escrito pela Irlanda, aquelas de $5, o cara olhava, a camisa do cara e disse, não tem problema. Não sei de ser. Uma barra, já faz como na mesa. Não está tudo aí. Tem problema. Só não vou pegar. E eu, vocês forem na balada, eu não vou, eu acho que o problema é o seguinte, eu levo. Eu acho que sabe. Só dois quilos, eu só cerveja, só 3 quilos. Não é como falando de entrar. Se você passa meu bebê, que eu me esqueço, porque é tranquilo. As coisas que estão doidas, é verdade, não sei se o Léo, o Thiagão, mas eu gosto. Não, agora na primeira é a seguinte: qual que é a proposta do jornalismo? Não precisa mais mudar lá. O que mais você está fazendo? Você voltou o carro? Vocês não foi, você não me falou de veio para Miami? Já fecharam? Mas a volta? A volta é tiro e mais não entra. This aqui. Só que aqui o ano de 7, fica mais caro, gente. Só fecharei isso antes para colocar a cara lá na hora. Esse é o meu projeto. Acho que assim, se for lá, não é diferença. Não, não sei o que, não shopping, se não tiver, se não for fazer isso, mas a gente não fala, a gente fala, se não tiver os negócios, a gente vai na solução feita. E assim,
Regardless his experience, like, clearly, you know, but then I get it. If you're just like, fuck it, I don't care. I haven't said jobs or well, yeah, he's not. No, I know. I'm saying the difference is like, he probably don't go back. Oh yeah. Because I was like, because I know I think he's still working.
Oh, I don't know if you put in there. Yeah.
I mean, I think the last time I was it's okay to do that. Something like 5 months. You're going to be just say, well, this for in October. Maybe that's okay. But then I was thinking the other day,
Yes, it goes.
Which is actually what I think I sent to you last year.
Well, that's actually it's like if they did a separate big thing, so they don't like turn 6 months. 6 months. Okay, so that's what you say. 6 months.
That's what I don't understand.
And I'm like, write an email to the guy. And he's like, I'm going to. I'm like, all right, I promise you. You can tell them and tell them that yeah. So he did it. And he wrote me back at like midnight last night. He's like, this is amazing. They got back to me. I'm going to talk to the guy tomorrow afternoon. And then he's like, it went great. Like, they want to have me in. I'm like, I'm looking for somebody. 2 months. They went through all their candidates at work.
Yeah.
And then they found me something. Like, I like wrote to them like after. Dude, what fucking planet is this guy like?
No, I don't understand. I understand coming to school that people were like this last September. I don't understand how since then. I think, especially if you're in a position now where you don't have a job or you don't have a job you want. I don't understand how you can be like that guys. I mean, it's like even with I understand last year and maybe even over the summer, but you would think that for summer it's great to sort of keep it in there like, hey, it's not 2007, it's not due.
I think there's going to be really good. I think that there's going to be some people. I'm almost feeling to a certain extent like I'm in a really good spot. I'm really happy. It's good. It's not exactly it's sort of like it could be happy there. Those industries aren't exactly that I want. I almost feel like things are going to start to open up a little bit, and like you're going to see a lot of people who end up getting into like some lower middle market funds that are just like random pluses that end up getting lucky there.
Yeah, I think that's true. I think that this is similar to like
We talked about
But it is going to be like really rapid.
You know.
I think it's going to be like, I think that the people that don't have jobs in August are going to probably have some good opportunities.
Maybe that's right.
Or maybe even in the fall. Because I think probably in the fall.
Basically, my sample set is like, I'm staying at this place for as long as I can, and then I'm going to go to one or two more. That's like my goal. And like, I already talked. It was great because you know that firm, Village. Yeah. So like, so Isaac used to work there. Which Isaac has been all that. Him lead because he knows the guys there well. So I want him to always say good things about him. But I actually, so when I got the offer at FTV, I actually forgot this. Yeah, so I talked to the guy, so that's good. And the guy was like, yeah, you know, I actually ended up talking to him the other day. I don't know. Oh yeah, I did. Yeah, he was like, yeah, maybe over the next couple of years we're going to be hiring. I mean, fuck that, that's great. And then my other one was in the summer. They actually wrote me a very positive email because I told them the managing partner was like, I knew that you guys would be great. I'm so happy for you. I still have a lot of high hopes of getting you down here, you know, for the next fund. I'm really happy that you basically, like, yeah, fuck yeah, man. Like, if you could raise a $300 million fund in 2 years, I could more than happy to sit around here for 2 years, make good money, hang out, like, you know, whatever.
Yeah, no, I think I think that part will definitely work out. I think that, I don't know, my sense is just, like you were talking about Apollo 1 the other day, I was like, oh, I sent you Jeremy a couple weeks ago, there's another guy, he's really good energy background, I don't know if it's kind of busy with that, but like, it sends him we're like started crazy, and I'm like, that's such a change, because in January, I think I emailed them somebody's resume, and it was like, yes, for sure, I'm consulting, we can give you babies, you want to hire anybody, awesome candidate, and they were like, oh, absolutely not, we're looking for like healthcare people in Dubai, and so and it's like such a rapid change that I think that, I don't know, like, I always see consulting as sort of a little bit of a leading industry with this stuff, and I think that, I just don't know how far. I don't think private equity is that far. I don't know how much capital works. I
think that private equity, I mean, still like, to me, the whole financial thing, the common thing I do, people start believing in private equity.
Yeah.
And so, like, I haven't seen that.
I'm starting to see it though. Pretty much every firm that has that still is working in private equity are all in the school.
Right, but that's an artificial like opening that like could end up in results. It's kind of like how I ended up, because there was like some like one guy left that was like kind of like my age, and then there are a few people that were pre-MBAs that are going to business school, and they're like, oh, you could hire a pre-MBA, post-MBA, let's just like hire everybody. Let's look at everybody, and then like if we like one of the post-MBAs the best, then we'll pay them a little more. If we like one of the pre-MBAs, then we'll pay them what we pay a pre-MBA. We'll like figure it out. And so I got lucky in that respect. Yeah. But that's still like, it's like not exactly, because I don't feel like, you know, I feel like.
You do that post MBAs, do that with as much as, what do you mean? Like the private equity financial. You think that like.
Back then.
You think they did, I don't know.
I feel like back then everybody was jumping ship. I mean, it was two things, people jumping ship and new firms being raised all the time. So it was like, who gives a shit, right? Like we could all, you know.
I mean, I get it on the pre-MBA side because it's like you see the money ahead of you, and it's not like you really know what you want.
But there's a lot of guys who are in private equity who, like, you know, maybe they're 3 years out of business school and they're just like they're doing pretty well for themselves, but like they're not sure that they're going to make a partner or whatever. And all of a sudden, some hedge fund is like, yeah, we're starting up some group to do like pipe deals. Come spearhead it for us, and like, yeah, give me the $3 million minimum. All of a sudden, oh, wait a second, like I was making this like really great salary, I was making $400,000 private equity fund, and all of a sudden, like, you know, that shit is off the wall. So, all right, so you're definitely writing your email now, or are you going to?
Yeah, I'm going to send them this email before I go.
All right, I'll talk to you later.
Hopefully before this fucking people at the low cap.
That is a delightful place to go to dinner, by the way.
PJ Clark's pretty solid, right?
I have leftover tacos that we can eat. See you later.
Later.
Very, very close.